What's up, Hot Take Nation? DRW here. Wanted to give a little preamble to the episode simply because we recorded it back before March 7th. Same topic, really important. Chapter 11, Chapter 7, 363 sales, bankruptcies, restructuring. Have a guest coming on the show, Bryan Lastrapes of Moelis Company, that really walks people through the how boards think about it, management teams think about it, the rights and obligations of each of the levels of security holders. And all of that was recorded, I think, March 2nd. And the reason that things have changed, obviously, is with the Saudi-Russia price war. Realistically, the U.S. is following the Italian lockdown, if you sort of read the tea leaves. And it is making people panic. I think we need to be calm. This too shall pass. But when we're going to be quarantined at home to try and slow the virus, demand of 20 million barrels a day of crude, you have to believe, is going substantially lower in the U.S. and other nations around the world. So I expect to see oil fall to the price at which significant amounts of U.S. production is shut in. I put all of that in context because the world did change, and this episode was recorded just before it. Same concepts, but in a $35 world, things are just massively different. So keep that in mind as you're listening, but I think it's a great educational one, and that's why we're here. Till next time, talk to you. What is up, everybody? It's DRW here with your Hot Take of the Day podcast. And I discovered that I say I am really excited about this episode, about every one of the episodes that we've done. So just take that as standard. I am very excited about this episode, and in particular because I am in Houston. I have Bryan Lastrapes of Moelis Company with me. Bryan, welcome to the show. Thanks so much for joining.
Yeah, my pleasure. Thanks for having me.
So the topic today is going to be all things bankruptcy and restructuring. And Bryan is, I think I'm going to call you the Holiday Inn Express of industry engineers with a huge depth of background that's now working at a firm like Moelis. And so why don't you tell us about how you got here and what it is specifically you're doing?
Sure, yeah. Thanks, David. So I had a 30-year career at Shell. I was an engineer, got into management, a lot of different commercial aspects of it, and left Shell about 8 or 9 years ago. And the last 7 years or so, I've been with Moelis. We're an independent investment bank. We do a number of things from M&A to capital markets to restructuring, and I think we're here today to talk a little bit about my experiences and what I've seen and observed, kind of as much from an insider but more from an industry perspective. I think I bring to the whole what I see in the restructuring process. Just for clarity, at Moelis, we do have, pure restructuring bankers. I'm an industry guy, and I work hand in hand with our restructuring guys when we work on these projects.
So let's come up with a hypothetical situation. I'm sitting in the boardroom of one of these companies, and I am anticipating that it's possible I could go into bankruptcy. What are the things that are being discussed in management, and what are the key signs that you would think to look for? I mean, obviously there's a difference between your equity value going to zero and bankruptcy. Can you maybe describe for our listeners what the difference between that is?
Yeah, there's it's a pretty long process before companies actually file for bankruptcy. A lot happens. It's not a surprise moment that all of a sudden I realize I have a problem. Companies in this environment, it's really tough. A lot of these companies were maybe capitalized for a different price environment. And so, guys are struggling, and given with gas prices and oil prices. But the three main things that you have to manage in this are you have to manage your liquidity, you have to manage your maturities, and then your overall debt level, right? You've got covenants and all that. So generally, those three areas, you see a problem coming in one or a combination of those three.
So let me use a hypothetical. I have a company. I have 3 times debt to EBITDA, something like that, and prices are low, so obviously that's going up. I have a covenant. Where would most covenants be set on these dets? Is there an average that you would say?
Yeah, the standard has always kind of been 4x, and you see those coming down. That people are trying to,
Right.
they're trying to get those down to 3x. You see, but most guys are still, their covenants are probably 4.
What do I have to do to get the bank to waive a covenant in a situation right now? Oil's 44, coronavirus, gas is $1.70. The world is, by any stretch of the imagination, if you believe that these prices are remaining, the whole E&P industry is worth zero. We're going to talk about that. But what do you do? Do you call up your banker and say, hey, like the world is totally weird and low prices. I need some run room with my covenants. What happens there? Does that happen ever?
Oh, it does. But it's going to be more complicated because a lot of guys, capital structure is not just bank debt. You have bank debt. You may have a second lien. You may have unsecured bonds, high yield. The guys that were able to hit that window or have built a set of notes that have unsecured debt. So you've really got all those issues to manage. And now high yield generally doesn't have the covenants. The secured debt does. Guys do go to their bank groups, or they do go to their creditors and look for relief. Generally, that can be, and this is where you get into, we kind of call it restructuring, with a capital R being bankruptcy and a lowercase r being, can I do some things to improve my balance sheet, but without going through a court process of bankruptcy. So
okay.
Can I get the banks to amend, to give me relief, to extend the maturity, to pick an interest payment if things are tough. But it's right now, it's a pretty tough environment to get a lot of relief from the banks. The banks are going the other way and looking to bring down exposure overall in the space.
And is the biggest risk to companies now if you have a lot drawn on your RBL versus some longer dated? I mean, is that where the banks are actually really pinching you down because they're lowering their standards? And if they trigger some sort of redetermination, which is why people are so worried about fall and spring redetermination, is it fair that it could be the RBL that is the straw that breaks the camel's back in the capital structure?
It certainly could be, and that's why people are worried about these redeterminations coming up. But it can trigger guys, but banks are reluctant to actually be the trigger, to push somebody into bankruptcy, to push them into insolvency where there is no out, and they have to file, and that's bankruptcy is an incredibly costly process.
So tell me about that, because I think that is a really interesting point. Is the joke is the only people that make money in bankruptcy are the lawyers and the bankers. The creditors don't get their money back. The shareholders get wiped out. And somehow the management team that ran it into bankruptcy ends up holding the keys on the other side of the process. So maybe give us a layman's Holiday Inn Express view of we've now decided, for all the reasons, we're going to declare Chapter 11, Chapter 7, the differences, and what does a bankruptcy process look like?
Sure, I'll take a stab, and you can guide me when I start wandering. A couple things. One is you don't declare a Chapter 7, just so people know. So Chapter 11 is a court-run process where the company gets a stay from creditors, and the company is basically given a minimum of 6 months of the exclusive window to put a plan together to bring to the court to emerge from bankruptcy. I'll come back to that in a minute. Chapter 7 is just a pure liquidation. Going out of business, fire sale, they appoint a trustee, and the trustee just liquidates the business. Period. Simple. That's all that happens. And so nobody declares that.
God, it just happens.
If you are that insolvent, and we haven't seen that happen in any of these E&P cases or oil and gas cases, because the courts, and we'll get into this, the process is intended to preserve the estate, to try and get the company out of bankruptcy in a way that it has a credible going concern coming out. So if you're like I said, let's go. There's 3 main components that may set you down that course. One is I just simply run out of money, liquidity. I'm out of cash, right? And if you can't raise money, the markets are fairly closed right now. So if you can't raise money and you can't pay your bills, you're going in. And
Is that mostly oil field services companies? I mean, I think about oil and gas companies, they sort of have revenue, they have hedges, but oil field services, I mean, if people just aren't drilling or they aren't completing or whatever it is, it feels like OFS is having more liquidity crisis. Is that fair?
Yeah, it's easier for those guys to have a liquidity crunch than an E&P who has a bit more current revenue coming in. So that might send you over if you just can't refinance, if you have maturity. And that's, I think, what we're seeing mostly right now are maturity-driven events where, look, this is just not refinanceable. Things are going to come current. I don't have assets I can sell. I can't go to the market. It's closed for me. So I see what's happening. You made an interesting comment about drawing the RBL and how some of this process works. What you tend to see is bankruptcy is a very expensive process. And one of the first things I was told one of the first bankruptcies I worked on when I got into Moelis was whoever funds that process has a large degree of control over the process. So if you're the company and I have money in my RBL, I have capacity, I can draw that money and put it in the bank. Now I can actually fund the process.
Right.
So then what happens is I now have, if I'm the company and I've gone down that road, now I have the exclusive right to propose a plan. And what that means is you've got various creditors who are going to, let's assume for this conversation equity is flushed. It's just easier to assume that. May not always be the case, but it usually is.
And so by equity is flushed, equity is going to zero. Anyone who owns common stock, the equity is wiped out.
Gone. And so then you're dealing with where in your capital stack, and let's assume it's more than just a bank debt. You have bank debt and something else. Where's the owner? Is the RBL covered and the owner is the second lien or the unsecured bonds or not? And so what'll happen during that period is, during this exclusivity period, is the various groups, the company and the various different groups of creditors try and figure out what might work. Is there a plan to fix this, right? Everybody knows the debt's going to get, if not fully wiped, substantially changed, right? So who's going to own it? Who gets the equity? Quite often there's an issue of who's going to write a check because the company needs to be sufficiently capitalized to actually come out the other end. And so those are called rights offerings. And so you might have a creditor or a group of creditors who like the company and might say, hey, I'll write a check. And for that helps recapitalize the company. For that, I'm going to get a lot of equity and we'll reinstate some or all of the debt.
And so you talked about all the levels of debt, and it's interesting because I think I have a pretty good handle on it. But I mean, we've talked about RBL, we've talked about unsecured, we've talked about secured, we've talked about second lien, we've talked about pref a little bit. So you have all these creditors that have first claim on the asset. You have shareholders that are wiped out. How do those guys interact in the play? Because, and I describe this to a lot of people who ask about bankruptcy. And so management teams are doing everything they can to avoid running through bankruptcy because instead of the shareholders who, let's be clear, governance isn't quite the level that we need it to be in an industry. So the board isn't really telling the management team what to do. They're just kind of saying yes. And as soon as the banks get there, you have these angry people that want their money back. And so how do those five constituents all figure out who's going to run it, and what do those negotiations look like?
Yeah, let me take a stab at that. I do want to make a comment, though, something you mentioned about board members, just for clarity. Once a company is deemed insolvent, there's a bit of a gray area. Once a company is deemed insolvent, certainly once it files, the board's fiduciary is no longer to the equity. The board's fiduciary is to the estate or the stakeholders, which then becomes a fiduciary to the creditors.
To the creditors.
Right. So their fiduciary changes at a point in time. Now that's I don't want to go down that road.
I think it's important.
I'm
it's an important point, though, which again, you have people who are looking out for the shareholders. They have a meeting in the boardroom that says we might be filing bankruptcy, at which point your allegiance is going to change to these people. And it's kind of an interesting process to think about. I'm defending these people all the way until they're all dead, and then I'm going to go and make new friends.
Or maybe they're all in a pot. You're still trying to figure out if you can squeeze equity value out. The company's legal counsel at that point will brief the board on what their obligations are to make sure everybody understands that. And so, to one of the questions you asked me earlier, board compositions don't normally change as a result of filing for bankruptcy. What happens when you file, you get a stay, and you run the business as you were running it before, just under a whole lot of scrutiny. And I'll come to that in a minute. So remind me to come back to that, because I want to come back to your question about capital structure and the players. In a hypothetical but typical capital structure, might be a typical capital structure where you have bank debt is always the first guy, the very top of the capital structure. So they're the most protected.
First lien secured.
First lien secured, first claim. You can then have a second lien, which is secured, but only after the bank debt is covered. Okay. You can look theoretically. You can have a third lien. You can have. We've seen 1.5 liens in between a first and a second. And then you can have unsecured debt, and then below the unsecured you have a pref, which is preferred equity, which gets paid a dividend, but it's really ends up getting flipped to equity. So what happens is in most of these debt issuances, you have intercreditor agreements, and these intercreditor agreements, it's very clear the pecking order of who has first claim, second claim, next level of claims. Sometimes they're pari passu. Sometimes you'll have some odd structures where you have two different guys and they have the same level of claim. But for the most part, it's a pretty clear and pretty straightforward. And that's where you see companies that are trying to restructure their debt out of court will say, okay, let's say I have bank debt, an RBL, and I have bonds, just good old bonds.
Yeah.
What they'll do is, and then the bonds, most of them get rated so they can get publicly traded. Let's say my bonds are trading at 50 cents on the dollar. So what guys will do is say, well, hey, you guys that own these bonds are already only worth half of the face value, so you're getting a nice coupon, but we're going to quit doing this. It's not going to keep going.
Right.
So we're going to flip you into a secured position at 60 cents on the dollar. So now you're taking the haircut, you're taking the hit on the face value of the debt. I'm getting to substantially reduce my debt burden, but I'm going to secure you for that, taking that pain. So they're now in a better place than an unsecured claim if it ever goes down the court to a bankruptcy. And then what happens is a lot of these intercreditor agreements also govern. They're not covenants in the sense that if the company busts a 4x debt to EBITDA, it's broken a covenant and it may be in default and may get pushed into bankruptcy. But they limit the company's ability to layer them with more debt. Sometimes, always above, but sometimes even below. So these intercreditor agreements can kind of govern the flexibility of the capital structure.
Do you think, and I'm asking you to speculate a little bit, and maybe you'll pass the question, but do you think that companies knew what they were doing when they were building these super complicated capital structures? And I imagine that a lot of them have been put in place. If I think about the time frame of our industry, 2008 to 2014 was the heyday. You could probably get really easy debt. You could get really easy first lien, and there was more money and equity that you knew what to do with. 2014 end comes, oil crashes. Now we have this sort of 2015, and companies because of covenant reasons, don't want to slow down, don't want to overreact, don't want to look like they're changing the course. So they want to stay the course, and they come up with ever more creative mechanisms to kick the can down the road. And so, is it fair to say that do they understand what they put in place and how bad it would be if prices stayed low? I guess I'll ask that first part of the question.
Yeah, I think people knew what they were doing. I think the way I'd answer that is their vision of the future is not where it ended up, and a lot of these companies are capitalized for just plain and simple a much higher price environment. And one of the things, so I'm an old school guy. I started in the industry, in 1981, right? So most of my growing up in the industry was conventional business. And in the conventional business, when you hit the price, the prices tanked on you, you would slow down your spend, you'd kill exploration, slow down your capital spend, sweat your assets, workovers, recompletes, cut your costs, hunker down until prices came back, and then go back about your business. And I think that's the oil and gas mentality. The problem with these shale assets is it's very hard to pare back. And so you simply have the problem of, I think, the shales with the capital treadmill makes it a lot more difficult to survive what we're now seeing is a fairly protracted low. Hopefully it's still a low, but It's a fairly protracted low. And so, you have now these debt structures, and once you've built that up, it's pretty painful to fix it. I mean,
right. So which is great. So we knew what we were doing, and I think it's fair to management teams. I mean, historically we've been a cyclical business, and there's ups and there's downs, and now I think there's a structural change in terms of the global demand supply of oil, plus all the other factors. But really, we have grown as a country from 5 million barrels a day to 13 million barrels a day over a 10-year period, have effectively filled all of the world's growth, and there's other countries that would have liked to contribute. So we have this oversupply, bad capital structures, and it seems like one small little breath like the coronavirus just triggers everything. So how far in advance would a company that foresees a potential capital problem engage your firm?
So at this point, I would say, and this is mostly, so again, I'll go back to what do you look at? You look at, if you have a level of debt, you have a level of debt. It is what it is. So the main triggers now people are looking at is my liquidity runway. Do I have plenty of liquidity? Am I good? Or is that going to run out, and do I need to do something about it? And then what's really driving that, what we're really seeing people talking about is maturities now, certainly 21s. If you have a 20 maturity, it's current and you are dealing with it. You have been dealing with it. And 21s, but we're seeing interest in, if I have a 2022 or a 2023, a substantial, maturity happen in that time frame. It's more the right way to think about it is, look, I don't want to wait until it's too late and I'm panicking, I don't have good options. I don't know that I want to do anything now, but what should I be doing now? And guys are very closely watching how those bonds are trading, because that's one of the triggers, and of being able to do something, whether it's exchange, whether it's any kind of just buying it back if you can get enough discount. I mean, if your bonds are trading at 80 cents on the dollar, it's hard to say, well, I'm buying them at 92 cents or 85 cents. I'm not really taking a lot of debt off my books, but I'm using precious capital to do it. And doesn't feel like the time to strike very often.
I mean, it's interesting here, and this conversation just really brings to the teeter-totter. They call it leverage for a reason, and the further over that you slide the teeter-totter to the fulcrum, you have these massive swings. And I think about it to your point. So you have this debt that's trading at 50 or 60 cents on the dollar, presumably, and you're looking at it saying, well, the bonds are yielding 15, 16%. Clearly the market thinks they're going bankrupt. And yet there's retained equity value, because if the equity can figure out some way to do a debt conversion, as we've seen a couple companies attempt or have success doing, all of a sudden that debt goes off the sheet, the covenants are safe, the equity comes back. There's just this huge swing that can occur.
Yeah, the price sensitivity is massive, and there's you would have to say, at least, and generically, if you have debt and it's trading at 50 cents, that tells you what the markets think of your equity.
Right.
So your equity really at that point is kind of option value, but there could be substantial option value in that equity. But it's more of option value that if some things can happen, if prices can turn around, if you can push out maturities for 5 years. Because look, a lot of the creditors aren't thrilled with the idea of owning these assets in this current environment. So there is room to say, hey, look, you got this 2021 maturity, push that back. I'll pay you higher interest rate because I have liquidity, but I just can't refinance you. I'll push you back. That gives me more time, and time is value and an option. And so, it's not an unrealistic scenario to think about that and go, okay, well, if my bonds are trading where they're trading, theoretically, my equity's not getting much value. It's not getting much love below these things. But
Right.
but there is a rationale to buy time, and the other thing you'll see is I think I'd say early on in 15, 16. When a lot of the earlier triggers, I think there were a lot of MLP kind of assets. There were some older, mature. Now you're seeing, I think you're seeing reasonable quality assets, at least in a probably $60 world, where they're struggling with the balance sheet they're toting around, and so there are guys interested in writing checks into that to help solve that situation, right?
Yeah, I mean, I certainly call it a crisis of balance sheets. So
Yeah.
we've now decided that we're going to declare Chapter 11. We've had you engaged for a number of months. We have the lawyers. You've given up all the options, and we say, look, there's no option. And then there is a catalyst.
Yep.
What is the catalyst that makes me then declare?
So it's generally, I have one of the problems I describe, probably one of two. I have a maturity I can't do, and I've run enough of the traps that I know I can't do an exchange. I can't do an out of court where I just doing some sort of arranged deal. I can't attract new capital. Nobody's willing to really come in at this point, and so I still so I want to file. I want to make that decision when I have sufficient capital liquidity to actually manage the process. And I'll talk a little bit about what happens if I wait too late.
Yeah.
And the other one is I don't want to be pushed into it. I don't want to be forced into it by a creditor that I haven't made a bond payment, that I'm in default, and if once I go past the grace period, I can get forced in. And that's generally a way more difficult process. And you've seen that happen almost none of the times in this cycle. So usually it's just an understanding that you've kind of run out of your rope. This is the right thing to do, and boards recognize that. There comes a time where the boards are like, look, and management is, okay, this is the way to fix this. These are quality assets. If we clean the balance sheet, this is a legitimate going concern, and I really don't have any credible options left. And by the way, in that process, when you really think about most of these bankruptcies, they're taking 6, 9, 12 months. A lot can happen in 6, 9, 12 months. So I haven't really given up on the equity yet, if I still have that in my head. I'm kind of going down that road. But things can happen in 8 months, and it maybe changes the situation. So what happens is I file. I
file with a court,
so
where I'm listed. So if I'm a Delaware listed company, do I file in Delaware? Which court system do I pick to file my bankruptcy?
You're seeing early on a lot more Delaware. You're seeing some New York, and now you're seeing most guys file in Texas.
Okay.
And it's a preference of the debtor, of the company. So when you file, you get the company gets an immediate stay, which means nobody can sue it, can force it. The company is expected and does continue to run its business in a prudent manner.
And so a stay would be the creditors can't say, give me my interest.
The creditors can't take their collateral.
Right.
They can't go and say, I have that set of wells as collateral. I'm taking.
Okay. So they get a stay.
They get full protection. And this is one of the advantages of bankruptcy. Is you have to go there, is you get court protection.
Yeah.
And it's a very legalistic process. So then you have a minimum of 6 months, and it's generally extendable if conversations are going on and there's progress on trying to come to a plan. The company has a minimum of 6 months to propose a plan, and what that means is, so not only can a creditor not seize its collateral, a creditor can't go to the court and say, here's the plan to get this thing out. I want to own it. I want to take. They can't do it. They don't get the right.
Is that where a pre-pack comes in?
No. Pre-pack's different. So a pre-pack, let's say I have a simple capital structure or a very simple story at the end of the day, maybe, and it's clear where the value is. It's clear who owns it. What a pre-pack does is you have a plan to emerge, and you actually have the agreement, if you will, and the votes of all of the groups of creditors that will vote for it. And you submit all that to the court, and generally that substantially lessens the time and the cost to do it. There's risk that the court might decide that that's not a good plan, or that they want to see something else. But
Right.
generally, everybody's agreed up front, and it minimizes the damage. Then there's a thing called a prearranged, where you have a plan, you have general agreement with the parties, but you go to court, you do the process, and then they vote, and things can blow up. You have to, a lot of these capital structures, you have a lot of money that's basically getting a zero, and those guys don't want to give it up without a fight.
Yeah.
Which is, I can't blame them.
Right.
And so it's sometimes not that easy just to get something through.
It seems like a typical almost civil lawsuit where, there's multiple options. You don't know the way the court's going to decide. You do the best thing you can, but once you enter bankruptcy, anything can happen within reason.
Well, the court is there. The court's there to get the most value out of or for the estate. I don't know the right way to look at it. And they are generally biased towards exiting the company from bankruptcy as a going concern. And so, mostly it's just, look, it's the company needs to wipe out a lot of the debt, maybe reinstate some of it, maybe pay those guys off and refinance some of it, clear who's going to own what, and then generally some money needs to come into the situation. Most of these plans involve somebody contributing some capital to the business to recapitalize it, because most of whatever cash is, or gets sucked out through the process, right? And so that's the negotiation that's going on amongst the various parties, and the more tranches of debt you have, from a bank debt to a first lien to a second lien to unsecured, they're all separate parties that are maybe negotiating with each other, against each other. It tends to feel, I'm kind of more of an M&A guy, but it tends to feel more of a fixed pie game than a grow the pie.
Right.
And so the negotiations get kind of interesting. And at the end of the day, and this is, I think, is back to one of the questions you want to get to, is back to the company. If I'm able to control the process and i.e. fund it, most deals, plans come through me, right? So this is why you see what you see with companies going in and coming back out. The companies have the money, they can fund it, and they will work with the various creditors and ultimately
be the ones who get to keep the keys.
They come out. Somebody gets the keys. They generally tend to stay on seat.
Yeah.
And so what I think you asked me about the employees and all. What?
Yeah, So we've talked a lot about creditors and bankruptcies and advisors and boards and court actions and negotiations. What happens to the employees through this process? Both, I think we've seen a lot of layoffs, and I think some layoffs are going to come in advance of a Chapter 11 declaration, which feels like sort of to your point, it's a one-way option. So you're doing absolutely everything you can to extend the runway as long as humanly possible, but at some point you realize you can't. Mm-hmm. Now all the employees are in. What do the courts do with the employees at this point during a bankruptcy process?
So the court really doesn't have, doesn't have jurisdiction over the employees, if you will. The employees are still employees of the company. The company's kind of in protected mode. But the dynamic is basically, G&A is not looked on favorably by creditors who are not getting their money back. So what you normally will see well before a filing is the RIFs. You'll see trying to
RIF being a reduction in force.
Yeah. You'll see. So the self-help, if you're going to ask me as a creditor or whoever to take pain, what are you doing to help yourself, right? Where are you really screwing down on your costs before you come to me with that? So companies will work that down. quite often by the time they get to filing, there's not that much fat, if you will. And the company is intending, and the court intends, at least for the process at that point, for it to emerge from bankruptcy. So there needs to be a fully functioning corporate entity.
Yeah.
So there is a point where you're unlikely to see further layoffs. In fact, you tend to see some retention packages, because if you really have good people and decent assets and you just need to fix a balance sheet, you don't want to lose all your good people. If I'm the incoming owner, if I want the best engineers in there, because when it comes out, I want it to work, right? And so, but it's pretty skinny down by that point,
Right?
And the kind of from an employee, but then back to the process. So what's probably bad for an employee from that perspective is if the company can't work out a plan, then what generally happens is the courts, they'll run a 363 process.
So the courts decide when it's going to be a 363, and it's based on acrimony between all of the creditors. So presumably a much more complicated capital structure has a higher likelihood of going to a 363 versus a simpler one, which seems to have more of a chance to come out. Is that a fair characterization?
I don't know. I think it's all
depends.
assets. It's the company's asset specific. If somebody wants to own them, that you probably end up with a plan, regardless of how complicated it is. And if nobody wants to own them, then it's hard to get a plan. And then what they'll do is, and this is not the Chapter 7 liquidation. The 363 process is basically an orderly sale as part of the bankruptcy restructuring through the court. And a lot of times it's done as a market test as much as it is just sell the thing, right? Because a lot of times people are reluctant. Well, let's see what we get if we go out for bids, and if we don't like it, well, then maybe I'll step in and do something. So a 363 process does not mean they are selling the parts or the company, but it's kind of heading down that road. And a lot of times it's the court will want to, like, let's say you have a lot of times what you have is a group of creditors, and let's say, who knows how many people may own the bonds, and 4 or 5 of them form an ad hoc group, and they negotiate kind of on their behalf, but on behalf of the bonds. And they may decide they'll write a check, do a rights offering, which means they get to write a check to earn so much equity as part of their plan.
Yeah.
And the courts might say that's interesting, but you're kind of stealing the company. Let's go see if we can sell it to kind of stress test. Is there more value there than what these guys are looking to do?
And we don't really see in the upstream side, we really don't see a lot of 363s unless it's, as you said, a really small company that has assets that are probably marginal, and it's probably been maybe through already a Chapter 11 once, or some other scenario. Is that fair?
What I'd say we haven't seen a lot of is actual sales transactions as a result of a 363 process. You see them in market tests, and then in this current market, there's no buyers.
Right.
The
only one I can think of is actually the Mock acquisition of the Alta Mesa assets was a 363 sale. That's the only one I can think of all the bankruptcies that I can think of last year. That's the only one I can think of that went through 363.
Yeah, and I think that's right. I mean, we go back. I think we did. Quicksilver was one.
That was way long ago.
But there's been a few of them, but there's been a number where there's been a process, and the process showed weak market interest, and therefore they confirmed the plan without going to the sale route, right? That was, which is the whole point of them.
So
can be the whole point.
So I'm going to enter bankruptcy, and we've had a podcast, and for the listeners who've heard it before, I think it was a good discussion with Aegis on hedging. But it's hard to sell an asset right now, and the way I describe it very quickly is a buyer has a 20% cost of capital from private equity or from some high yield mezz structure. So they want to buy an asset at PV20 at the low strip. And the seller, who's trying to cover their debt, has a 6 or 7% current yield. So they need to sell the asset at a PV6 or PV7 because that's how levered it is. And so because that spread is like 2x, you basically can't sell an asset to fix it. And we've talked about fraudulent conveyance, which I'm not going to come to you with right now.
Good.
But what I want to ask the question of is, if I monetize, like with these companies, there's options. Can you sell your hedge book and get a waiver from the banks that says, I know I wanted all this, but I would prefer the cash for the mark to market, because if prices stay low, you're going to a zero anyway. And so I will use a gas company, and I won't name the name so I don't get you in trouble, even though you're not related. But a company has $750 million mark to market of hedges. Gas is $1.70. At $1.70, the company's at zero anyway. So therefore, the bet is gas has to go back to $2.50 at some point. So why not liquidate that? Since you could liquidate it, use 100% of those proceeds to pay down the debt, so that's the way you buy runway, and then you do some other things. Do companies talk to you about that in their advisory meetings, and are we seeing that?
All kind of options. It's tough though. So let's say you're the bank.
Yeah.
And and let's say I have the bank debt, but I have other debt, and my other debt's getting hammered. If I'm the bank, I'm not so happy taking what's protecting my collateral to pay that guy off, and then being more naked and exposed. Then I'm going to make you put new hedges back on, but they're a different price. I don't like that.
Right.
There's a lot of sensitivity in these distressed situations about money going out to lower parts of the capital structure.
And so again,
right?
and this kind of level, this makes the point, the more complicated the capital structure, the more constituents there are to fight when you're doing something that's logical. Sell this to pay down this because this is secured, you're unsecured, we can float longer, we're going to do this smart move. And everyone's like, no, I want a big piece of pie when this thing goes to bankruptcy.
And a lot of it depends on what intercreditor agreements allow for or prevent.
Right.
I will say, to flip that on its head, while I don't disagree with you, sometimes the more complicated the capital structure, the more flexibility I have as a company to do things.
Because I have more constituents.
I have more guys to play with to try and get something constructive, or to play them off of each other.
Right.
And so more complex is generally bad, but it's not always bad. It might allow you a little more, as a company, a little more freedom to try and make some things happen than just having one guy to negotiate with that just says no.
So how about this? Now, I have this equity that I can't raise new capital with equity. As you said, the capital markets are closed. I think that's about as evident as it's ever been. But I have equity that has some intrinsic value. And it's backed, by some asset value net of my debt, so I know what it's worth. Why are guys not going to their peers and saying, I have low debt but shitty assets, and you have high debt but better assets, and so if I take you over, we can combine and kick the can down the road, which will then get our, crush the shorts, equity goes up, we'll do it again. Like, with the pain that people are experiencing, what is the reluctance right now to come together and get married?
It's probably a whole lot of things. We do agree. I would agree that we think, M&A needs to happen. It's merger,
merge or die. That's where we're
for
at.
A lot of these guys. But it's hard to make hard to make some of that work in reality. There's not a lot of clear operational synergies, significant G&A synergies, and then the combined balance sheet actually is materially more interesting or different. Guys that don't have a bunch of debt are really reluctant to merge into guys that do have a bunch of debt.
Right.
That's a hard thing to swallow. And then for the guy that has a bunch of debt, their equity value ain't very much, so they're going to get very little out of the combined if you just do that math, right? So there's just a lot of hypothetically it makes all the sense, but in the real world of company A and company B, there's a lot of reasons why there's still reluctance.
But isn't that terrifying? Because and so I'll pose this. So I'm a shareholder in some company, and I'm looking at their balance sheet, and I say, okay, 2020 maturities, 2021 maturities, 2022. They're trading at 3.5 times debt to EBITDA. I think their covenant might be 4. They've ramped down, but they're still not really ramping down. I mean, at some point. And I know that this isn't practically how it works, but I mean, the equity is actually worth 0. I know it's trading at something, but for all intents and purposes, it's worth 0. Why does equity not trade closer to 0 far in advance? And again, there's this option value, but it feels like some guys should be way closer to 0 today than they are.
Yeah, and it is option value, and it's, if you think about, let's say you bought a stock at 100 and it's down to 4, and I'm not thinking in my particular, I'm just using simple numbers.
96% down.
If you've ridden it down to 4, you may as well sit on it.
Right.
And nobody's buying into it.
Right.
At 4, so you're just going to sit on it. It's going to sit there, right? There's no liquidity to that market. If I think it's worth 0, I may bid a point, and you're going to go, well, I've already taken this kind of bath.
Right.
Why am I going to get out now, right? So I'm not. I'll just sit on it, and it'll sit there, and maybe something good will happen. That's the option game, and time is your friend in these situations.
So it feels to me, and what's interesting of that is what you're saying is it makes all the sense in the world to merge, but because of everything that's happened, they basically feel as though they have to go from, and I'll use a less aggressive number, but I went from 100 to 30. And it seems like the management team is more willing to let the stock go from 30 to 0, go through Chapter 11, come back out with a clean balance sheet, and then figure out what to do, than they are to say, look, at least it's 30 now and we can do something different, which to me as a shareholder, unsecured, that terrifies me if that's the mentality of a 100 to 4, I get that, but like 100 to 30, how could an investor look and see the companies that seem to be more willing to drive from 30 to 0 and restack and come back out the other side? Is there a rule of thumb you would advocate for?
Do your homework. But what I'd say is, I think managements are not looking to do that. I think it's always situational specific, but you have to sit in a boardroom and go, okay, what are my credible options here? And do I believe them? Do I have them? Or am I just making shit up and I'm dreaming? And if that's the case, then you have a fiduciary at that point, I think, is I got to fix this.
Yeah.
So we haven't, I don't think we've seen management teams that say, well, let's just drive this thing into the wall and fix it, and I'll come out with a MIP on the back end. That'll be good for me. That is the end result of some of these situations.
Right.
But I think it's more of a result of, in any specific situation, I've played out my option value on the equity as long as I can, and I can no longer do it. As a shareholder, I think you just have to look at, you have to do your homework. Liquidity, cash generation, real track record. Are these believable type curves? Are these believable cost structures? If they're paring back on CapEx and are going to be free cash flow neutral for the first time ever, is that sustainable? You got to do your homework, because some of them are going to do okay.
And for me, for what it's worth, the reason I always defer back to the smog for the weak or the bad is it's an external type curve mostly, or at least an external audited. Mm-hmm. It's a limited development plan. It's based only on proved reserves. It's at a fixed price. So as a relative value, it's a really good way of saying, well, I might be wrong, but these guys trade at 3 times that number. These guys trade at 0.6 times that number. I feel better about one than the other. But yeah, what I've seen is people, the 5 major bankruptcies I think about last year, and I won't mention their names, but we've talked about them in previous podcasts, is they all declared when their smog fell below their long-term debt. Mm-hmm. So if they had $1 billion smog and their debt was 1.3, that was the trigger in almost every case. But when they maintained a SEC asset value above their debt, they seemed to continue to kind of flounder until that happened.
No, it's not a bad metric. It's just the only issue I think most of us have with that is that it's a point in time pricing. And if the point in time pricing is not all that relevant, then I don't know what to do. I don't know how to flex that.
At 47 versus 55, I mean all the profit's gone.
It makes a big difference, and these guys, these businesses are hypersensitive to $3, $5, $10 or 50 cents MCF.
So something our industry, I can't even remember. I've been in this industry since 2000, and other than one case in Canada that I can remember, nobody goes hostile. And it seems like, to the scenario you described, where management team is trying to do this and trying to do that and trying to buy time and trying to kick the can, it feels like there are some companies who have a stronger balance sheet, can understand the assets, can consolidate, and would you advise or do you advise companies that are coming in saying, you know what, I love that asset. I think that management team sucks. I know their debt's high, but if they come with me, my debt will help balance them and we're going to soar. I'm coming in hostile. Do you think that this environment now we could start seeing some hostile transactions occur?
You know, if you have buyers show up, you may not need to be hostile in this environment. There are just very few people looking to acquire in a way because they're looking at it going, I'm not going to get rewarded for growth, and if I do this, I'm going to get hammered. Right? There's not many acquirers that look at the situation, and very few of the deals that you've seen, and none of them have been hostile, have been well received by the market. The market is kind of skeptical of these synergies, or skeptical of if you're taking on more debt in that situation, that's a good thing. So a lot of the calculus from the buyer side of that equation is, how's the market going to reward me for this? And the general answer to that is, the conclusions are generally they don't think they're going to.
Which is actually, I mean, it is kind of funny, right? Because we can all sit and say, hypothetically, we think consolidation makes sense. We have too many companies, and too many companies have too many vested interests in certain outcomes. And so unlike Saudi Arabia or Russia, as a member of OPEC, the whole country says open or close and everyone acts together. Whereas in the U.S., against our own self-interest, we have grown production 1.2 million barrels over the last year, which has basically oversupplied the world, which is basically the cause of oil at 45, which is why all of these people are going bankrupt. And if there were less companies, again, this isn't collusion, it's not coordination, but if there were less companies, people have less vested interests. So that's the one side. And then the other thing is, and I use Oxy as an example, and I use SRC PDC as an example. You know, Oxy was trading at 60, and now they're trading at 30. Most of their peers have traded down just as far. And so everyone points to, well, that Anadarko deal was really bad. Your stock got hammered. Well, you can plot them against basically any company, and all of them have struggled. And in the SRC PDC case, I use that as an example because they traded up, but they happened to announce right around the Houthi rebel attack. And so they traded up, and basically since September, E&P has been in a death spiral of valuation. Yeah. So it is hard to differentiate, like, well, the market will punish me, to which I say, can they really punish you that much more? I mean, we're basically at zero equity value.
That's a fair point.
So, I mean, so I'm hopeful, and I liked your point on the hostels. I'm an advocate of, if you want the asset and the management team won't talk to you, just go hostile. But to your point, if the management team is being practical and they're not willing to run it from 30 to 0, they probably want to have a merger partner. And so maybe we're now finally at the point where the next 6 months sees an M&A and health comes back to our industry.
Yeah, I love to see it. I'm working on a lot of bankruptcies, but we'd like to see the M&A market come back. And it seems like it should. The cash buyers for A&D kind of things are still tough, but you would think that the MOE kind of structure,
that would be merger of equals.
Yeah, merger of equals, which is basically stock for stock, and in this market, probably with virtually no premium.
Yeah.
Then you just get in a relative valuation, which should be more doable than an actual cash transaction. And, you know, the G&A matters. Real synergies matter. The ability to allocate capital over a broader set of assets matter. And if in the combination I can delever a little bit, it helps me a little bit there. But it's just it's kind of, you made a point, and you know, there's a lot of people spending a lot of money, and it's like we said earlier, you've got guys that are trying to maintain leverage ratios and other things that are drilling where maybe in a perfect world they would prefer not to, and that's maintaining a supply, that's maintaining a price, that's maintaining the pain.
Yeah. And there's your leverage. Yeah. Is you do the right thing and it happens 3 times and it's a massive beta up, and if we continue doing what we're doing, it's been a massive beta down. Well, that brings us to the end of this conversation, and I hope for everyone out there appreciate, first of all, Bryan, thank you so much for bringing me to the office and having this conversation, because I think there's a lot of questions around what it is and what is bankruptcy and how does it impact employees and where are we headed as an industry. I think it's fair to say that 50% of companies are dead men walking, and that the reality is they're probably technically insolvent even if they're not actually insolvent. And so I think we are going to see a lot of mergers, but also a lot of bankruptcies in the next 6 months. So hopefully this is like bankruptcy 101 for everybody listening. As always, you can follow us on the web at www.hottakeoftheday.com. You can subscribe to our podcast on wherever you listen to your podcast. Best way for us to get out there and start talking to a larger audience than just Energy Crowd is to write a review if you like what you hear. You can always email me with questions, drw@hottakeoftheday.com. And until next time, be safe, be good, have a great week. Bye for now.